Welcome to your next edition of EXP's Express Recordings. Our next section continues with individuals, but it's the fringe benefits that an employee or a holder of an office receives from the employer or the company that he is director for, in addition to the basic package. This results in an increase in the gross salary received, and it ultimately affects the taxable income. When we look at fringe benefits, we've got to look at a taxable value of the fringe benefit, and we look at the application of Section 1, which is gross income, and the special inclusions of paragraph C and paragraph I. And we look at Section 8.1 of the Income Tax Act 58 of 1962. Paragraph I includes in gross income the cash equivalent determined under the provisions of the 7th schedule of the value of any benefit or advantage granted in respect of employment or to the holder of any office, which is very, very important, and any amount required to be included under Section 8A, which is any share incentive scheme available for the employees or holders of office. Any voluntary awards, there are two provisos to paragraph C. It does not apply to any benefits or advantages which have already been dealt with in paragraph I. And it also tells you if a person renders a service and another person receives this amount, the amount will be included in the gross income of the person who renders this service. 7 schedule benefits, these are the lists of it. Assets acquired at less than actual costs, right of use of an asset other than a motor vehicle or residential accommodation, because those are dealt with on their own. Meals, refreshments or vouchers, free or cheap services, low interest loans, housing subsidies, payment of an employee's debt or release from an obligation to repay it, and medical aid contributions. The taxable amount of a fringe benefit is referred to as the cash equivalent. Section 8.1 includes in taxable income a portion of certain allowances that have not been expended for business purposes. And it deals with advances, allowances, etc. It defines an allowance as an amount of money granted by an employer where the employer is certain that the employee will incur business-related expenditure on behalf of the employer. The employee is not obliged to account for it. An advance is where the employee has to prove business expenditure and refund any excess to the employer. Traveling allowances, there are 2 types of travel allowances. An allowance or advance in respect of transport expenses, or an allowance or advance to be used by the recipient for paying expenses in respect of a motor vehicle used for business purposes. An allowance for a motor vehicle used by an employee, the portion expended for business is tax-free. Anything in excess of that will fall into the recipient's taxable income. By the recipient, we mean the employee. The portion expended for business purposes is calculated in one of 2 ways. Actual business kilometers traveled multiplied by the deemed rate per kilometer if accurate records of business travel have been kept and actual expenditure incurred. Business allowance, actual distance traveled for the year multiplied by the deemed cost per kilometer, or expenditure actually incurred where you have proper records to substantiate this. The rate per kilometer is determined as the sum of the fixed cost divided by the total kilometers traveled during the year, where the recipient has borne the cost of fuel, the fuel cost, and where the recipient has borne the cost of maintaining the vehicle, the maintenance cost. If you are using actual costs, the actual costs are used where accurate data for business travel can be provided, and the value of the motor vehicle in this instance is limited to 480,000 Rand, with the wear and tear to be determined over a period of 7 years. Any finance charges must also be limited to the cash cost of 480,000 Rand. A reimbursive allowance. If the employee has traveled for a distance of less than 8,000 kilometers and there is no other allowance that he is receiving in respect of this vehicle, he can claim an amount of 305 cents per kilometer. That in your normal language is 305 cents a kilometer. Our next reimbursive allowance is a subsistence allowance. It's in respect of expenses actually incurred or to be incurred on personal subsistence and incidental cost, where the taxpayer is obliged to spend at least one night away from his usual place of residence. The recipient is deemed to have expended the following amounts: 286 Rand per day if the allowance is paid to defray the cost of meals and incidental expenses, 88 Rand per day for incidental expenses only, and whatever amount the Commissioner may allow for travel outside the Republic. Remember, it varies per country and it applies to periods spent outside the Republic not exceeding 6 continuous weeks. Allowances to public offices. A deduction of employees' tax from 50% of the allowance with full disclosure. The balance of the 50% of the allowance is taxed at a rate of 25%. Then we get to 7 schedule benefits. An employee is deemed to have been granted a taxable benefit if one of the following is bestowed on him by his employer: a benefit or advantage by virtue of his employment or as a reward for services rendered. The official rate of interest from the 1st of March 2011 is 6.5%, and this rate is based on the repo rate. Assets acquired at less than actual value. You will look at the market value of the asset at acquisition or the cost to the employer less any consideration paid by the employee, and this will be the amount that will be taxed in the employee's hands. The use of sundry assets. A taxable benefit arises where an employee has been granted the private or domestic use of an asset either free of charge or for a consideration less than the determined value of use. Remember, this is not for motor vehicles or residential accommodation. The use of motor vehicles is completely different, and here we're looking at employer-owned motor vehicles. Please remember that private use is traveling between home and your place of work. Where the employee has the right to use more than one vehicle, he will have a determined value of 3.5% per month of the determined value of the motor vehicle. If he has more than one vehicle, it will be 3.5% per month of every vehicle. If the motor vehicle is subject to a maintenance plan, this amount is reduced to 3.25%. If the vehicle is used for part of a month, you must apportion it on a daily basis. Meals, refreshments, and other vouchers that an employee is given by the employer. If it is given to all employees, there's no cost. If it is given to specific employees, it is the cost to the employer is the value that will be added to the employee's gross income. Residential accommodation, this can be furnished or unfurnished, with or without meals, or with or without power. And it is the rental value for the year less any rental consideration given by the employee, subject to the following formula: A minus B multiplied by C over 100 multiplied by D over 12, where A is the remuneration factor, B is either 59,750 or 0, D is the number of months that the employee has actually lived in there, and C is either 17, 18 or 19, depending on what the employee gets. If he gets furnished with meals and with power and water, it will be 19, and it must be at least 4 rooms. If he gets at least 4 rooms but with 2 of those, it will be 18, all the others are 17. Holiday accommodation. If your employer gives you the use of the holiday house in Zimbabwe, it's not free. Remember that. A determined value will go into your gross income, and it is either the rental value, the amount that the employer pays for it, or a market value which the employer could get if he let that out per day. Deemed housing loans, where the employee has a right to acquire residential accommodation at a future date in terms of an agreement entered into with the employer. The employee is deemed to have been granted a loan equivalent to the agreed upon purchase price. The taxable benefit is the difference between the interest on the loan at the official interest rate and the rental paid by the employee. Free and cheap services. If there is a free or a cheap service, the difference between the normal price and the reduced or the free price is your taxable benefit. Low interest loans, the same thing. The difference between the market rate of loans or the rate that SARS applies, which at the moment is 6.5%, and the rate that you actually paying your employer, if it's 0, it will be 6.5% minus 0, so it will be 6.5% off. If the loan is for 100,000 Rand, multiplied by the number of months you actually paid it, and that will be added to your gross income. If you are paying 2% on that loan, it'll be 6.5% minus 2% multiplied by 100,000 Rand multiplied by the number of months. That will be the taxable benefit. Housing subsidies. If a subsidy is paid by an employer in respect of interest or capital repayments, the cash equivalent of the value of the taxable benefit is the amount of this subsidy. If the employer granted the employee a loan, then you will use the official rate of interest. Discharge or release of obligation. A taxable benefit arises when the employer has paid an amount owing by the employee to any third person without requiring him to reimburse him or release the employee from an obligation to pay an amount, and the taxable benefit will be the actual amount. Medical aid contributions. Where your employer makes any contribution, it becomes a fringe benefit and the cash equivalent is included in the employee's remuneration. Taxation of directors and employees at the vesting of equity instruments. Any gains made by an employer or made by a director or employee by virtue of the exercise, cession or release of a right to acquire a marketable security, which is a share, is included in gross income if the right was obtained before the 26th of October 2004. And that is all that we have to say on fringe benefits. Thank you and see you at the next recording.